Yeah.
Because that was our, and the girls would all, because that's Color My World, from Chicago. It was my wife, that's our favorite song, whatever, so it's like, they all come to the stage and did it, but it was me. It's a different life.
Well, I think this is on.
Yeah, gotta be careful. Got a hot mic. I don't know if we have a,
Yeah, I mean, I was just moving through with the arrow keys.
this is a small arrow key.
Or if you hit the space bar, does it do the same thing?
Yeah. No.
No, I said the space bar.
Oh, that, yeah. Yeah, I guess it does.
Okay, so you can aim for the space bar.
Yeah, I was sort of hoping we might get a pointer thing, but probably not, so. I mean, you could, like, if I was gonna talk about the rates, that's the new rate that's in here for the singles.
News on the left.
Yeah, so then I'm blocking it, but, if you look at that rate over there, going to there, and then over here, they were at 24, and now they're gonna be at 33, so something like that. So we may, just to, brighten, leaven things up a little bit, just to kind of walk in front,
Yeah.
something like that, I guess.
Yeah. The podium either.
Yeah, so I had that in there, and then said most of them go into 24%. Most people going from 28 to 24, really. Oh, that's right, it's used, yeah, so it's 1,300 more, so. Key tags. I might just jump in on you a little bit, just to, if I see,
Yes.
have something in there.
Feel free to chime in, certainly.
So I was just thinking here, in case we do medical, like when I go to medical deductions, and I say, well, basically, always remember, medical is really something that's not, expenditure that's not beneficial for the general health. It's not for medical. It really is. Just to add that, could have added that as a slide, but I might just read that. Deduct more if we're in, if you can have more payments because of assisted living or nursing, you should consult your tax advisor about whether you can deduct all of those or not. And then that would be, and then this one here where we didn't really add it in a slide, but if you're going to have this large deduction, I would say that you're going to have, potentially you have no income, maybe by $50,000, if there's an extra deduction that you're going to go. So if you're having a required minimum distribution, if you can take money out of your retirement account, maybe you should just do that, and then you make your income equal your expenses, and you have no tax, but you've used up $50,000 of your income. Might have been easier if I had a slide on that, but so I figured that might take a little bit, and then I was thinking of, should we ask them if they have any questions about the letter? I don't know if I want to do that.
I don't know if I want to volunteer.
Yeah.
I think people will.
I said, I'll make it stop and say, let's just stop. Do you have any questions about the medical? After we do that in general, and I gotta believe that we'll do that.
Yeah, I have a feeling that
That's gonna probably
will come up.
Yeah.
I mean, that's probably the biggest tax event in a lot of these people's lives.
Right. I would guess so. And then we talked about the $24,000 deduction, but actually for them it's $26,600.
Right. Right.
Or $25,600, I guess, for the $1,600 for them individually.
Yeah, actually, I don't give it too much thought. Do you get that on top of your itemized deduction too, right? I mean,
it
it's
just adds
not, right, but I mean, so if you're itemizing, it's not like you now have to clear a 26.5 hurdle.
Well, I don't know, I guess that means
I just
if
couldn't,
everything, if you're below that, doesn't really matter. So yeah, if you're doing charitable deductions,
yeah.
doesn't matter, yeah, you gotta, yeah, because you get that anyway, so you would need to clear that.
Okay, yeah, no, so that was my question, if it was an additional deduction, whether you itemize or take standard, or if it's only on the standard.
Oh, I think it's, well, the 2,600 is really the standard. 26,000 is the standard now, because you get 24 in general plus the 2,600 more, so it's 26,600, right? So if you have itemized deductions, what's your question then? If you have 10 for state,
So my question was, is that extra for old or blind, it's only added to the standard deduction? Yeah, so
Right.
I couldn't
Yeah.
remember mechanically if it also got added to the itemized
No.
deduction.
all right, no, it just gives you more of a threshold not to
Yeah,
bother
right,
itemizing.
yeah.
Right. Yeah. All right. You want to, you can take a walk with me if you want, or you can stay here.
Maybe I'll hang out, I'll read through the slides one more time,
Okay.
make sure
I brought some,
I have something to say.
I brought some stuff in the, anything here too, in case they talk about like being chronically ill means being able to, unable to perform 2 activities of daily living for at least 90 days, you know, so
Mhm.
just, I have a feeling that's gonna come up in some way, but I figured I'd take it out and read it,
Yeah,
you know, and all that, so. Just gonna say, these things are you know, I don't wanna say anything off the cuff, so let me go back to this and read it to you, whatever.
right,
All right, so I'll be right back.
okay.
Why these MRs and stuff wouldn't be on it. I gotta find out, but I think,
You know what, I'll get a 14-foot ladder here, I'll have it here, and if you ask Mark Browning, then we'll just do an inventory.
this is the only stage in the place, right?
That I know of, yeah.
From what I was told, they're just gonna go with all, but they have all these CFL bulbs, I mean, I don't know why they wouldn't wanna just, it's all screw-ins. They were thinking, I think of, tubes and stuff, but they wanted to just be fluorescent. Maybe these are on dimmers or something, and they,
Yeah, they are, there's over here. There's a switch that does them all. Yeah. Sharon?
I am Sharon. You're the first to arrive.
Yeah. Well, we have 20 minutes to still.
Yes. You wanted to get a front row seat then.
Well, I want to take some notes because a couple of people who could not be here asked me to take notes and give it to them because they have got some classes at Yale or something like
Yeah,
that. So.
okay. So you have homework.
I'm sorry?
So you have homework.
Yeah. I wonder how many accountants, we go to an accountant to do our taxes. They must be up to date on the laws that you.
Well, that is certainly the hope, yes. I know in our firm, we've made some efforts to get educated. There's still a lot that's unclear though, because the regulations haven't been written yet. So in certain cases, we're making some assumptions, but, yeah, these were some massive changes.
I read it yesterday, an article saying that Paul Ryan made the statement, I don't know whether you read that or not.
I might have missed it yesterday.
Yeah, Paul Ryan said that we should applaud the fact that people are going to save $1.70.
I did see that, and a little comment about, oh, she'll be able to pay for her Costco
Costco
membership.
membership.
Right, right.
And then he pulled it out because people were really, really attacking him for saying that. I mean, to say that $1.78 per week is the big tax cut that they are offering, I don't know.
Well, I do think a lot of people will see more than that, but most regular people I don't think are going to, it's not gonna be a huge swing one way or the
Yeah,
other, you know.
yeah. Do you practice in Hampton?
So we're with Beers Hammerman, Cohen and Berger. Tony and I are both mainly out of our New Haven office.
Yeah.
We're down Whitney, down the road. But I live in Hampton.
Yeah.
Hello.
Hi.
How are you? Hi, I'm Sharon. Nice to meet you.
It's a hot mic.
Just want to say hi. What you guys doing?
Yes, I did. This is like quite a game.
I'm not even a football fan.
Yeah.
Right, yeah.
I know. I like this non-football comic.
It's funny, my mother-in-law actually is a huge football fan, so she was the most excited of all of us. My brother-in-law's from Boston. He actually lives, so he had friends over that were Patriots fans, and he was him and my sister-in-law were going yesterday, so it was cool to see their friends close. Yeah. Exactly, yeah, exactly. Yeah, that's what I said, that's what I said.
Well, we use an accountant's company. We have one in West in Rutherford too. Yes, we do have a person inside the office who actually can tell you. But I want to hear what you have to say. I'm also taking some notes from Dr. Schwartz. Good morning. And who said at a class at Yale today. So, right? Yeah. Everything in handouts. I didn't see it. Yeah.
Yeah, well, the thing is, I just hung up on it because I just got the good reports, and I said, this is not my husband. But I had to call to get my husband. I got the amount immediately, so now I've got everything. I'm just
I want to find out what they're going to eliminate this time. They're going to erase the individual deduction to $12,000 per person, and for a couple, $24,000. They're going to say
You
that.
mean for the amount of deductible?
Right, yeah, yeah. In other words, they want to do away with individual itemized deductions. Not just raise it. So, yeah. But let's see what Tony has to say.
Yeah, but this, he's not gonna talk about that. Oh, you're talking about this was the taxable deductible?
Yeah.
Ah.
12,000 per individual, and for the couple, it will be $24,000. And they're doing away with itemized deductions.
Yeah. At this point, I don't have a big amount, my medical is not that big. I've got a lot of it.
But I'm not
There
so
were
sure
some
that,
people here
that
earlier, but they were talking about
they're
like
going to take away
LED
itemized
and
deductions.
like,
I do not know.
yeah.
So we'll
Greetings, everyone. Can you hear me? So we're not going to start immediately because Terry is out looking. I guess there's some people who may want to come in, so we're going to give them a few minutes to be able to take their seats, and then we'll begin. And if we start a few minutes late, we'll be here until we answer all questions, until we go through everything. So it might be just another few minutes. Yeah. Good. All right, well, maybe we can go now. Okay, so maybe we'll start now. Welcome, everyone. Thank you for coming. My name is Tony Santor, as you can see, and I have brought an associate of mine. Well, actually, just as we say that, we're having some people walk in, so let me just have a minute here. Okay, so as I said, my name is Tony Santor. I am a partner with the firm of Beers, Hammerman, Cohen & Berger, and I brought an associate of mine, Sharon Bruni, who was also a partner in our firm. And we're going to go over some of the individual changes that have occurred as a result of the recently enacted Tax Act that happened in December of 2017. And just as a reminder that all the changes that you've read about are effective starting January 1st of this year. So when you're filing your tax returns through April of this year, it's really for last year's rules. So everything we're talking about is going to be going forward for the year of 2018. Anecdotally, by the way, I just let you know that I have been here. So I'm a member of the board of directors. So this is my 7th year. I was a past president for the previous 3 years, and I've also had a chance to go through the wellness center, the health center, excuse me, because I've had my in-laws here, both of them on short-term rehabs over the last year, and my mother recently had fallen in an accident, and she's in there now for the last few weeks. She's recovering nicely, and she commented to me how good the food is, and that they're always giving her quite a lot. So I mentioned that maybe not everybody has the same experience, so you may want to just keep that to yourself, so that if you're looking to improve some things, maybe you don't want to just ruin it for everybody else. But she's very happy here, and I'm sure you know that everybody here everybody is so nice in there. So anyway. So our focus is going to be about the changes that have happened as a result in 2017 going into 18. There are business changes as well as individual. Our assumption is that most people don't really care about the business changes, so we're going to focus on the individual side for this presentation. And again, as I mentioned before, this is going to be for 2018. I'm going to go through and just give you a kind of a summary of what those changes are for individuals, and then we'll kind of go through some of them in more detail, not all of them, because many of them are not necessarily going to be impactful for most of the returns. So there's going to be, the big one is going to be the first one, tax changes that are going to be the rate changes. So there's going to be tax rate changes on regular income, but there's no change in your capital gains rates. this may not be as applicable for everybody, but there's a change in the kiddie tax for people who have grandchildren that might be having a tax on their income. Their rates are going to be changed. There's a repeal of personal exemptions. There's an increased child tax credit, which again probably won't be affecting most people here. There's an increase. Now we have the nomenclature AMT, but that's really for the alternative minimum tax. And maybe if, for those who are not as well versed, there's two systems. There's a regular tax system and an alternative minimum tax system. There's an increase in the exemptions for that. We'll go through that just briefly. One that's going to affect a lot of people will be the additional standard deduction. That's been changed. There's an improvement in the medical expense deduction, which I think will be helpful for most people here. There's also a limitation on your state income and property taxes. Some additional limitations on your mortgage interest deduction, repeal of the 2% miscellaneous itemized deductions. No personal and casualty loss deductions anymore except for the presidentially declared disaster zones. No deduction for moving expenses. And this one may be helpful for you as we cover it. The ability to use a Section 529 plan, which is a plan to help fund tuition for elementary and secondary school. And for those who will be affected by, who have divorces and alimonies, I mean, there's going to be no more deductions for alimony payments, and people who are receiving alimony won't have to include that in income for at least new agreements that are happening for 2018. So let's go into the rates, and we have them listed here. So the general, just the overall is that for the most part, the rates have gone down. So that's why when you hear our politicians speaking, most people should be getting a tax cut for this year. It's obviously going to vary by what your situation is, but because the rates are down, you would think that most people will have lower taxes going forward. Interestingly, though, for some people, it may not be quite as much as you might think. And I'll just take one example, and it's going to be for single taxpayers. I'm going to just leave the mic here. So if we look at the 28% bracket for individual, for singles, it goes from $93,000 to $195,000. So those would be taxed at 28%. And then under the new law, people from 157 to 200, which falls into this 28%, they're going to be taxed at 32. So depending where you are in the spectrum, you might see, if you're in that particular bracket, you may actually have a tax rate increase. That doesn't mean your taxes are going to go up, because there's some other things that might offset it. But it's not just in general everybody's brackets went down. It's all going to be where you fall in that spectrum. So obviously that's one thing, that's going to be a reason why you're going to want to consult your tax advisors early to see where you are in that income bracket and what that rate is going to be. These are the rates for the married taxpayers, and for the most part, I will just use an example for where a lot of people fall when you talk about middle income. If you're in this bracket of $156,000 or here at or $230,000, somewhere between 77 and 237, you're in a 25% bracket right now or a 28% bracket right now. This bracket now over here from 165 to 315 is at 24%. So for many people who are in a 25 or 28% bracket right now, they're going to be at a 24% bracket. Hence, that's why most politicians say that you're going to get some tax reduction as a result of this bill. So I'm going to bring up Sharon now to go through a few other slides.
Hello. So we'll bounce back and forth as we move through the presentation, but the slide here on the capital gains tax rates, just a general reminder that the structure that's been in place for the past few years as regards the tax rates and the thresholds at which they apply, there really hasn't been a change there. So pretty much status quo on the capital gains treatment. Short-term capital gains are still taxed as ordinary income, and the 3.8% net investment income tax did not go away. There's certainly been a lot of talk about getting rid of the Affordable Care Act, but the taxes associated with it at least look to still be sticking around. And Tony alluded to the alternative minimum tax. Just very briefly, there are two systems under which your taxable income and tax are calculated. They then get compared side by side, and you pay the higher of the two. So there was at some point some discussion that the AMT would be going away. However, in the final version of the Tax Act, that was retained. However, it was the exclusions were expanded, and so it is expected that fewer people will be subject to paying that AMT tax. And then this was one of the big selling points under the headline of tax simplification, that the standard deduction would be greater than it has been in the past, thereby allowing many people to avoid the detail and data gathering related to itemized deductions. So as you can see here, not exactly doubled, but close to it for married taxpayers, going from $13,000 for a standard deduction up to $24,000, and single taxpayers $6,500 up to $12,000. The additional standard deduction for those age 65 and up, or for blind, was retained. 2017, that's an additional $1,250. 2018, that's expected to be an additional $1,300 per person. And sort of in partnership with this increased standard deduction, the personal exemptions are now suspended. So people who maybe had a large family, many children, might not be so excited about this because they had been able to collect a larger deduction due to their personal exemptions, so that has now gone away. So simpler, perhaps, in many cases, but depending on your exact specific situation, may or may not be exactly helpful to you. And the kiddie tax, again, probably not directly relevant to you, but if you have perhaps engaged in some estate planning and transferred some assets to grandchildren, perhaps talk to your kids and your grandkids, they may be paying a higher tax going forward because the tax rate on unearned income, so investment income like interest and dividends and capital gains, for minors, people under the age of 19, and college students, that will now be subject to the trust tax rates, which quickly get to a high level as compared to individual tax rates. And I'll just jump ahead here. As you can see, by the time you've had income of $12,500, you're at the top 37% bracket. So it may be a situation where you would want to revisit some of your estate planning, or some tax moves that you had made in the past could perhaps be coming back to haunt the younger taxpayers in your life. And the big item, especially that we heard a lot about in Connecticut, the limitation on property tax and state income taxes to $10,000 for those filing as married couple, and $5,000 for those filing as a single taxpayer. In some cases, if you're not itemizing, this isn't such a big deal, and everybody can benefit from that new standard deduction. But if you have been paying large amounts of state income or property taxes, this has been quite a sticking point for those of us in Connecticut, New York, and California that do have fairly high rates. And I believe I'll pass the baton back to Tony.
Thank you. Our next topic will be on the medical deduction. And I thought, just in general, we should just go over what is a medical deduction. And I'm going to read it because it can be a little more precise. Generally, medical care is defined as the amount that's paid for the diagnosis, cure, mitigation, treatment, or prevention of disease, or for a purpose affecting the body's structure or function. Also, medical care relates to transportation primarily for and essential to medical care, obviously qualified long-term care services, and any insurance for medical care. Generally, I think we all have a feel for what medical care is. Medical deductions would be good for. Basically, if an expenditure is just beneficial to the general health that you have, it's not a medical deduction, not allowable for medical deduction. But for something that is, again, for a diagnosis or cure, or for all the things I just said, they would be eligible for that. So I'm assuming many people might have taken that in the past. So the medical expense deductions are going to be subject to 7% of your adjusted gross income for the years both 2017 and 2018. And we're going to go through an example of that, but let's just take it to, I want to just sort of bring it back to something that you're all going to be familiar with, which is the letter that David Ratliff had sent out and commented on what your deductions would be for medical care here at Whitney Center. So if you've been a resident for a while, as a married person, he wrote that as they've calculated it, you would be eligible for as a single, you'd be eligible for $16,320 of your monthly fee that would be attributable to medical care. Therefore, that would be put on your tax return as a medical deduction. If you were married, that number doubles and it would be $32,640. Just to bring it back to simple examples, if that were your only medical care, you wouldn't be allowed to deduct $32,000 if you were a married person, because you first have to subtract out 7.5% of your adjusted gross income. So without getting into what adjusted gross income is right now, just assume that you've got $100,000 of what that is, which is going to be dividends, interest, any capital gains, all those sources of income that we like to have as in our pockets, but not like to have taxable. 7.5% would be $7,500. So you would put in $32,000 for your medical deduction, but then you'd subtract out $7,500, and the net of that would be what you would use when you're going to compare whether you would itemize, as Sharon mentioned, as to whether you would be above that standard deduction amount that has now been increased. So again, we'll go through an example of that to make it a little more clear. Let me see, did we pass a slide on that? Yeah, so, okay. So again, that slide that I just said, I sort of talked about what that is. In addition, if you have incurred some additional costs for medical care here at Whitney Center that you are paying for, in addition to what your monthly service would be, and that would be for something maybe related to it, for something in the health center or whatever, that relates to medical care, it is commonly accepted that you would be able to add to that. And so in addition to the $32,000 if you're married, if you were to have paid maybe $10,000 in additional medical care costs from things at Whitney Center, that you'd be able to then add that $10,000 and have a $42,000 medical deduction. So when I say that it's commonly done that way, it's because there's really nothing in the IRS regulations that will quantify, well, will tell us that black and white that's allowable. There's some comments sometimes that says, well, you're taking, without getting into too detailed, it's that you've already been paying for your medical care that's going to occur for many of you in the future. So the fact that you've got some additional medical care expenses, the IRS could assert that they're not exactly deductible. So there's a little bit of a gray area on whether it's, whether you can take it. So being aggressive of taxpayers but trying to stay within the realm of what the boundaries are, it's commonly done. But as almost everything that we talk about, you should consult your tax advisor as to whether you would want to do that, to make sure that you're comfortable with that and to know what the ramifications are if he felt that he didn't really want to go beyond what is strictly written in the code for that. Let me just stop there. Do we have any questions so far? Yes.
When you talk, can you clarify the difference between those of us who are on the regular Whitney Center contract versus modified versus unbundled?
Well, unbundled would be where you're paying for you pay as you go. And is that right, Michelle? Is that, yeah, so basically then if you're paying for medical care, for your medical treatments, those you would add up, and those would be your deductible amounts. For modified, I guess I'm not quite sure what the difference is with that in terms of your, you're talking about a modified in terms of you're paying a lower monthly fee? Why don't you clarify that for me?
So for those of you who are living here on campus at Whitney Center, the modified plan, if you have that contract, means you can supplement it with your long-term care insurance. So Whitney Center covers the first 100 days of your medical care, and then you're responsible for day 101 up until that second year. After 2 years, Whitney Center, then you'd be on a regular life care contract.
Okay.
So that would be referring to the life care contracts. That first 2 years just isn't covered under a modified plan.
So the letter that David had sent out covers life care contracts, as though, and so you're paying X dollars a month, and so there's a calculation that has been done that says of all the expenses that Whitney Center has, 30-something% of it could be deductible as medical care. So to the extent that you've paid less, I would use the same percentage of a standard, whatever you've paid from, whatever that Whitney Center number is, I would say that's going to be the same percentage in there. However, if you've paid something more directly, personally, you would want to add that to that number. However, if it's covered by insurance, obviously you wouldn't be able to deduct that. So if it's only going to be out of pocket, net out of pocket, more than what your insurance would be. Yes?
Could you help me to clarify the individual deductions for all those things that we've been able to deduct in the past under the new law? What impact does the new law make on deductibles?
Deductibles for medical or?
Maybe referring to 2% itemized.
Oh, you know what? We'll come back to that. Let's just stick with the medical for just this now, and then we can come back to that because we did touch on that a little bit. You know, some of the other deductibles, what Sharon had mentioned is that if you were deducting your state income taxes, there's a limit on that now. So we can go through what that is, and I'll just give you just the overview is if you were to be deducting miscellaneous itemized deductions, which might be your fee paid to your tax advisor, to prepare your tax return. That potentially was deductible in the past, and that's all of those items that go in that category are no longer going to be deductible. Maybe we'll go through that after we finish the medical example that we have. Okay, so let's just go forward for the next item on the medical, which is for those of you who are new, would be the entry fee. And if you're a new resident in 2018 and you have paid an entry fee, again, it is commonly held that you will be able to have a percentage of that deductible in the year that it is paid. So I'm thinking of David's letter there, it was like 36%, I think, of what that, I think it's what it is, 36%?
Yep.
36% of that entry fee, whatever that number is, and it varies among people. So now, that's a fairly large number. So for many people, that's a very valuable deduction to have in the first year that you are here. And again, as David mentioned in his letter, if you were to split it between 2 years, it would be deductible in the year paid. So you might, depending on your situation, if you were to have a certain amount paid in December and a certain amount paid in January, they would go in 2 different years. So I would say that everybody that we know of and we talked and we started surveyed, everybody who gets a letter like that will deduct that percentage. And it can be, so if you've paid, $300,000 as an entry fee, you will deduct $108,000 or something like that. So that could be significant on your tax return in 1 year. There is a little bit of risk in that because while it's been determined to be deductible in many cases, the IRS has also had a couple of cases where they've pushed back and said, well, just because you paid $400,000 for a bigger apartment doesn't mean you should get a larger deduction than somebody who's paid $250,000, because the difference in your fee was not because of medical care, it was because you paid for larger living accommodations. So while that has been out there, and there's one case where the IRS asserted that and won, there's been others that they've asserted that and not won. So we say it may be deductible, and you should discuss it with your tax advisor because it's a number that will be very large in your return. So when those things are there, there's probably a little bit greater chance of scrutiny, and you want to be comfortable in being able to take that. Having said all that, I will tell you, if somebody were to come to us with that letter, we would deduct it. So again, because we think we have enough behind us that if an agent were to challenge it, we'd be able to provide justification for it, and we think we would win. But it's not 100% that we would win. So anyway, any questions on that? Yes? That's not different, actually. I just threw that in because it's here. I mean, that particular deduction is the same as what you could take in 2017. The difference, actually, there really isn't anything in the new Tax Act that is affecting that, other than the amount of your tax benefit from that may be a little different because your standard deduction is a little different, and so there may be, whether you take it or not is an issue. But really, if you have a refundable amount, you're always going to itemize. You're never going to take the standard deduction because that'll always be more. If you're a single person at $16,000, I guess you would still probably deduct that also. So for many people here, you probably won't be taking the standard deduction that's higher. You'll always be itemizing. Because the amount of the medical deduction is usually going to be higher. But depending on what your source of income is, if your gross income is very, very high, it'll limit it because of that 7.5% that I talked about before. I shudder a little bit when I start throwing these numbers out because it can, we kind of work with them all the time, and I know you work with them like once a year for a few minutes. And so if I get too complicated with what I say, then you can just raise your hand and we'll try to simplify it so that we can get a greater understanding for everybody. Okay, so one of the other changes is that your charitable deductions, which used to be limited in any 1 year to 50% of your adjusted gross income as far as the maximum, so that typically didn't affect very many people unless they gave large gifts. So if your adjusted gross income was $100,000, you gave a charitable organization $70,000, you would only be able to deduct 50 because the old rule was 50% of that, and the remaining 20 would go forward into a future year. They've liberalized that now and made the percentage 60%. So if you did that same example and you had a $100,000 income and you gave somebody $70,000, you'd be able to deduct 60 on your return this year, 2018, and you'd carry forward the extra 10 to the following year. So I think from that, this is a more complicated area, so then I need to bring it over to Sharon.
All right, we'll touch on this a little bit. This also was perhaps a big newsmaker in the itemized deduction arena, mortgage interest. This isn't going to impact really too many people who have an existing mortgage, but people going forward taking out new mortgages, their interest deduction is limited to $750,000 instead of the prior $1 million. So people who have an existing mortgage, that deduction is grandfathered for you. The interesting little bit that can affect more people probably, people who had a home equity line of credit and use those monies to do things like buy a car or take a vacation, or basically do something other than buy, build, or improve their home. You used to be able to deduct interest on up to $100,000 on that type of a loan, and that is no longer going to be deductible starting in 2018. And Tony touched on this a little bit. They're referred to as 2% miscellaneous itemized deductions. So these were a sort of assorted group of deductions that were subject to 2% of your adjusted gross income. So many people actually didn't see a large benefit from these deductions anyway, depending on how high your adjusted gross income was. But they are just gone now in terms of being deductible. So some examples there, tax preparation fees, legal advice for things like estate planning, broker fees, all fall into that bucket. So take a look at your tax returns for last year perhaps and see what was in there and if you had any benefit from that last year. The hope though, of course, is that the higher standard deduction would offset the loss of these 2% miscellaneous itemized deductions. Do you wanna?
It's me again.
Yeah, all right. So a small planning opportunity for everyone.
So in the event that people don't itemize, even though I think you might be itemizing, in the event that you don't itemize, one of the, even if you talk with your friends who, one of the issues that might happen to people if you don't itemize is that any donations you make won't be deductible anymore. So that's affecting many charities. They're nervous that, many people, while they value the good works that organizations do, the fact that they get a tax deduction gives them that extra incentive to make a donation to them. And with the change in the law, it's possible that donations you'll fall under the standard deduction and you won't need a tax deduction. You won't get this tax deduction for your charity deductions, your charitable donations anymore. So one of the options, if you were in that particular situation, is to bunch them, meaning that maybe, and the numbers here are going to show various limitations that we have. Again, if you're limited at $10,000 of state and local taxes and your mortgage interest or so is 10 and your donations were 4, you normally would have a $24,000 potential itemized deduction, and you're not going to get any benefit from that because you already get a standard deduction that's going to be higher than that, so it won't do you any good to save you any taxes. That's where so if you don't do any, if you decide to not make any charitable deductions in 1 year and double up on them in the following year, then in the following year you would have, instead of a donation of $4,000 that you would normally make, and you made $8,000, there you'd be higher than the threshold, and therefore the donations would be deductible at that point. Again, this is just a simple example, and it kind of just talks about the theory of it. So this is something that, as you read some articles about what people are going to potentially do to try to get some deduction for their donations, this is something that is probably going to be coming up for many people. The charities are not going to like that because they rely on their support every year. And if people are going to do a small amount one year and double amount the following year, that could affect their cash flow a little bit. So we'll have to see how that sort of plays out. But it's something that is probably going to be affecting, many charities starting in 2018. And so you'll probably be hearing more about this throughout the year. Did you have a question?
Yes. Earlier, it was reported that charitable gifts are limited to 60% of adjusted gross income. And how does that fit?
So I said 60% of adjusted gross income is the limit you can deduct in any one year if it's cash. Which and again, not everybody. Some people donate stock, and there's a lower percentage for that, which would be 30, I believe. No, cash stock, publicly traded stock is 50. I'm sorry, but in this example, $4,000. So if your adjusted gross income was with your dividends, interest, and your required minimum distribution from your IRAs and whatever was, I want to use 100,000 because the math is simple. 60% of that, as I mentioned, was $60,000 would have been your maximum amount. In this particular example, it's 4,000 or 8,000. So because it's lower than that threshold, you can deduct it all. So if you were at a $50,000 of adjusted gross income, you would be able to deduct up to $30,000 in charitable donations. So as long as you kept it below that, you would get the full amount in the year that you did that. Is that clear? Okay. Okay, so now we have another planning opportunity that relates to your charitable deductions and your required minimum distributions that I'm assuming everybody knows about from your retirement accounts, which again, coming from your either 401ks or your IRAs that started when you were 70 and a half. So those amounts have to be taken out every year, and that contributes to your adjusted gross income. So this is nothing new with the Tax Act, and I'm going to let Sharon explain it, but it is something that has become a little more valuable because of the limitations that might happen because your donations may not be deductible in the current year, as I had just mentioned.
All right, so some of you may have even done this in the past, but this has become a little bit more valuable, as Tony mentioned. As you decide to make charitable contributions, you can do it in one of two ways. You can just write a check from your checking account, or you could also call your broker or advisor that handles your, say, your IRA, your retirement account from which you might take your required minimum distribution, and ask them to pay the charity directly. So the benefit to that is it doesn't factor into your taxable income at that point. You never received it, and it doesn't get treated as part of your adjusted gross income. You don't get to take a deduction for the charitable contribution, but you end up not paying income tax on that piece. This, as Tony mentioned, the interplay between the itemized deduction and whether you have enough there or not to have a benefit to itemizing versus taking the standard deduction. In certain cases, if you're not itemizing, this could be a very good way to still further reduce your adjusted gross income, your taxable income, by making those payments directly to the charity. And in this example, if you had interest and dividends of $20,000, you have your required minimum distribution of $50,000 for what would be a $70,000 adjusted gross income. You could collect that cash and send some to the charity personally, or, as I mentioned, you could call your IRA custodian and ask them to send a $10,000 contribution to the charity directly, thereby reducing your adjusted gross income. So you still, if you're in that situation where you're taking the standard deduction, You still get that benefit of the $24,000 standard deduction if you're married, but now your taxable income is down quite a bit. There's also a benefit on the state income tax side, since Connecticut piggybacks off of the federal system, taking their starting point for computing your tax as adjusted gross income. In this particular situation, if changing your adjusted gross income by $10,000 here just saved you $550 on your Connecticut taxes. So there's a benefit on the state side as well.
That's a question.
Oh, yes.
It must be from an IRA. It cannot be from a retirement account.
No, you could, there are a myriad of retirement accounts that might require required minimum distributions. And
But I'm saying the distribution to charity must be from an IRA. So you have to roll over from your retirement account 403B or 401K into an IRA, then you make the charitable distribution.
actually, you should be able to arrange a direct contribution to the charity. They wouldn't do it for you. Oh. I mean, it will, I guess, vary from custodian to custodian. Perhaps they have their own rules, but generally, I think they could be able to. It may be that certain custodians don't. So certainly consult with your custodian if that's something that you're wanting to do, but it can be a very beneficial tax move. Do you want to?
Okay. So there's one other benefit to having that money go directly to a charity if you're going to make a charitable donation anyway. And that is, as Sharon mentioned, it lowers your taxable income, or it lowers your adjusted gross income, as well as your taxable income. And if you recall, in one of the earlier slides, we talked about the medical deduction that was based, first you have your total amount that you've paid, but you can't deduct it all because you first have to exceed 7.5% of your adjusted gross income. So if your adjusted gross income is lower, then you will have a larger amount of your medical deduction that will be deductible. So let me go through an example with that. So as I said, we're going to take the example of the married couple here in the life care contract at Whitney Center that is deducting $32,000, that has expenditures that are eligible for a medical deduction of $32,640. And we're going to make the assumption, just because of the math, to make it simple, that they might have other medical deductions that are allowable of $5,360. So when you take those two numbers together, it makes a nice even $38,000. And if you look at the bottom, if you do have a required minimum distribution, and in the previous example, if you were to have taken $10,000 of that and directed it to go to a charity, then your adjusted gross income was $60,000. And if you didn't do that, and you wrote a check out directly, your adjusted gross income is $70,000. So the effect on the medical, what you can deduct for your medical, is based on, again, 7.5% of your adjusted gross income. So if you've done that direct transfer to the charity, the threshold that you have to get over is $4,500. If you didn't do that, the threshold you have to get over is $5,250. So by directing a certain amount of your, we'll call it IRA distributions, to go directly to a charity, in this example where we did $10,000, you have had $750 more in your medical that is going to be deductible. So if you're in a 25% tax bracket, you'll save 25% of that $750, which is not a lot, but it's better than nothing when all it is just a matter of doing something that is just a phone call to your broker. Let me just stop there because I know we threw a few numbers up there, and see if we have any questions about that. Do we have any questions about anything else? Did I answer your question, sir, about the other deductions that you said that are being changed, or what the effect will be?
I think so.
Okay. Yes.
Could you say a bit about gifts in kind to, for instance, a library or museum, gifts of material like collections?
Nothing's changed with that.
Nothing's
So-
changed.
so-
Get an appraisal.
Just get an appraisal. Yeah. So, I mean, nothing prohibits you from doing that. I think if you want to do it, you should do it. And again, it'll just go as part of your charitable deduction. And as long as you can itemize, you'll get a benefit from that. Again, if you can't itemize for whatever reason, then it would be something good to do, but you may not get the government to give you any money back because of it. Yes, Michelle.
Tony, I don't know if you're gonna talk about this in future slides, but if you could review what the difference would be for Thrivent home members versus somebody who lives here on campus.
We don't have a slide on that, but really the Thrive at Home members, we feel, are really working in the same model as the Whitney Center members in that, as David mentioned in his letter, their Thrive at Home members have a monthly fee. And they don't, right now, because Whitney Center is relatively new in this program, they can't cite, 3 or 4 or 5 years worth of data on what that is, but the projection is that approximately 80 to 85% of the expenditures that are being incurred now by Thrive at Home members for your monthly service fees would be deductible as medical costs, because that's the only thing that you really have to go on. Again, you're going to need to consult your tax advisor because it's a new program. So, if the IRS were to audit you, they might say, they'd come back 2 or 3 years later, and then they'd say, well, you deducted 80%. How do you know that number is good? Because the program just started. Well, 2 years from now, you'll have some history and you'll have some actual data, and that whether it's 80 to 85 will be determined. Hopefully those numbers are going to be okay, and then nothing would happen if you deducted it, and the agent would say fine. If for some reason the number turned out to be 50%, it's possible your tax advisor would say, well, we based it on an estimate, and when the actual data came in, it was a little bit lower, so we should amend your return to do that. You have 3 years to amend returns for situations that are just like this, so it's not uncommon to have amended returns, and there's nothing bad about doing that. I mean, but if the alternative is to deduct nothing, that's not good either, because that's definitely wrong. We may not know exactly what it is, but we know it's not zero. And the best guess is that it's somewhere around 80 to 85. So your tax advisor may say, let's be conservative and do 70, and then we don't have to worry about an amended return. That's why we say you need to consult with that person and see how comfortable that person is after and how you are in making that deduction for you. That's on the regular monthly amount. For the entrance fee, I believe it's going to be the same. It's the same model. You're really paying in advance for potential medical medical payments that are going to occur in the future, which is why it's allowable as a medical deduction in the current year. Your number, if you were, if you had $100 and something thousand of an entrance fee for a Thrive at Home member, right now, again, consult your tax advisor, but we would probably deduct 80 to 85% of that in the current year as an advance payment of future medical expenditures. That's for a non-refundable plan. To the extent that it's a refundable plan, and this goes for Whitney Center life care contracts too, if you decide that you were going to deduct the full amount, which includes the refundable amount of the payment of the entrance fee, then what happens is when you actually do receive the refund, either because you were to leave the facility or in the event of your passing, your estate were to get it, it would be that money would be included as taxable income in the year that you got the money back. So you would get the deduction, today. You may have to pick up income, 7, 8, 10 years later, but there would be a recapture of some of that income when you get the money back. For those of you who don't get any money back, it doesn't matter. If you then you can get the deduction and nothing to worry about. But for the refundable amount, there's a day of reckoning when the money does come back to you. Yes.
Following that, if you have paid the $100,000, say, and your plan is to move happily to the Whitney Center campus and put the $100,000 into an apartment, then you would be anticipating no refund, even though you have a refundable first membership fee. Is that your understanding?
Well, so you're paying $100,000 today, and it's refundable or not refundable?
It is refundable.
It's refundable. Okay.
But I expect never to have it refunded. I expect to turn that $100,000
Right.
towards an apartment the decade from now.
So if I heard that, if you were my client, I would say, well, since your expectation is, first of all, you have the option of deducting it, even if it is refundable. So I would deduct it. And then when you change your fact pattern later on and you say, well, now I'm going to use that and I'm going to purchase an additional, I'm going to move in, and so therefore I'm not going to get that money back anymore, right? And you're probably going to pay some additional money on top of that. Then I would deduct that you're going to make the, let's say you pay another $200,000, 5 years from now to come to campus. I would deduct the $200,000 5 years from now. And then you would have, as we mentioned before, if you make the payments in 2 different years, the deduction goes when the disbursement is made. So you deduct your 100 the first year, 5 years from now you deduct 200, and over time, the medical piece of that, right? I'm sorry, when I say 200,000, so when I say I'm glad you mentioned that. That's why she's here, to keep me on track. So if you paid 100,000, you're going to deduct 36,000, and on 200,000, because your percentage, well, excuse me, the 80%, I'm sorry, the 80% for the Thrive at Home is I see what you're going now. So 100,000 from Thrive at Home gives you 80,000 as a deduction, right? So then you go into a life care contract 5 years from now, that's 200,000 more, example, right? And that's going to be at 36,000, but that's interesting because you might have had some of those payments in there. I guess, I guess we haven't really thought about that, but it's possible. I guess the best case scenario would be you would take your 200,000 at the 36% rate and do it and do that. Or another possibility would be to say, if again, because we had the benefit of hindsight, you would take the historical 300,000 cumulatively and say, if we were to do this, 300,000 times 36% is, call it 90,000 or $90,000. And if I took 80 already, I would only deduct a 10 to get it cumulatively caught up. So there's two possible options on that, and your tax advisor would be the one to probably consult with. My guess is he would say not to do the second one, to do the first one, to be more aggressive with that. That would be what I would probably do. Yes?
It was said that we are to get tax cuts. Who is getting the tax cuts? The large ones.
The large ones? Well, as simple mathematics say that if you are making more money and you are paying more taxes generally, you will get a larger tax cut. So, for instance, I'll give you the extreme example just to illustrate a point. We ran one of our clients who has $400,000 of adjusted gross income in various categories. And because of that particular situation, with the change in the rate and the change in some other things, that person's going to save, was it $23,000, I think was what it was, something like that. A pretty significant number. Of course, he pays a lot of taxes too, but so he's going to save a large amount. If you're in a lower income bracket, and if your taxable income is $80,000, you're not going to save $20,000. So, but in general, most people should get a tax cut. The exact amount can be much higher if your income was comprised of a business investment that you have, where you are in what's called a pass-through entity, limited liability company or an S corporation where the business was giving you income for it, there's a much more significant tax deduction for that type of income. And as Sharon mentioned, there's no change in the capital gains rate. There's a small rate decrease for normal income on dividends and interest, but there's a very sizable decrease if your income was coming from a business that you might still have an ownership percentage in, and you're getting that income reported to you. That particular income generally will be a 20% reduction off of that. So if you had income from a business on your tax return that was $100,000, you would get a $20,000 deduction. And if you were in a 30-something% tax rate, that would mean a $7,000 benefit just from that alone. So a lot of this depends on how your income falls out. If your income consists primarily of dividends, interest, and retirement contributions, you'll get some deduction because the rates are lower, but it probably won't be as significant as though if the same person next to you had a business income, not so much dividends and interest, because that income got reduced a lot more. Does that clarify?
I read that President Trump said that he would have a terrific loss if this bill went through. And then he's telling people they're going to be happy for people.
Mr. Trump said that he was not. The bill was going to be difficult for him. Yeah. I'm not quite sure that's true, but we'll have to wait for those tax returns to come out, and then we'll see whether that's actually true or not. Having said all that, regardless of the effect on his situation, I can tell you that from just discussing this with our clients, and many of them are actively in businesses right now, there's quite a lot of excitement, wouldn't you say,
Yes.
about the tax reduction that has happened for businesses. Whether it be a pass-through entity or a regular operating corporation. So many of our small business owners really do feel that they're going to get a big tax cut this year, and hopefully they'll be using that money to buy things and improve the economy, which then helps us all. But certainly those types of owners are going to have a much bigger benefit than people who are just getting dividends, interest, and pension money. Yes?
Are all of the changes of the new law applicable to our 2017?
No. 18. Only for 18. 18, and for most of it's going to be for 18 through 2025 for many of them. The bill, interestingly, they're set to expire, all these changes, in 2025, and I believe it was done just to get the budget deficit number to be somewhat palatable, because certainly the general feeling is that once you're in it, it's going to be very difficult to change it in 2025, but we'll have to see what happens at that time period. But yeah, for this current year coming up, the tax filing season today, you're getting all your tax documents coming in. Those are going to be under the old rules that were there in the past. Any other questions? Okay, we got a couple of other items, and then we'll wrap it up. Sharon?
Okay, this might apply to some of you with grandchildren and great-grandchildren, perhaps. The Act now allows people to use their 529 plan, so that's a college savings program is how it's normally been defined. You are now able to use up to $10,000 per year per beneficiary for elementary or secondary, public, private, or religious schools. So in the past, this has been restricted to college tuition, room and board, that sort of things associated with university learning. But now people who are in private schools at the lower levels can still get some benefit. if you are making contributions to a Connecticut 529 plan, you can get a deduction on your tax return for your Connecticut filing of up to $5,000 if you're a single filer, or up to $10,000 if you're a married filer. So if you are in that situation where you're lucky enough to contribute towards a younger family member's education savings, this is something to strongly consider. You are also able, the annual gift exclusion is $15,000 in 2018, so you can gift, each person can gift up to that amount to another individual per year without being required to file a gift tax return. If anybody is perhaps making any changes in their marital situation, consult your legal advisor, but any existing agreements that are out there, the tax treatment of those will continue going forward. No changes for an old agreement, but for agreements that are specifically modified related to these tax implications, or for agreements that go into effect in 2019 and the future, the payment of alimony is no longer deductible, and the receipt of alimony income would not be taxable income. Tony touched on it a fair amount, but the big excitement really in this for a lot of our small business owners is that pass-through deduction of 20%. This is a really complicated area with a lot of very specific definitions and limitations and thresholds. So if you happen to have income of that sort, definitely consult with your tax advisor on that. And many people, though, will see a nice benefit to this 20% deduction for pass-through entities. And in terms of estate planning, the federal exemption for estate and gift tax has doubled starting in 2018 from 5.6 million to 11.2 million. Connecticut is also on that bandwagon. They've, in their most recent budget year, they've increased the exemption from 2 million to 2.6 in 2018 and 3.6 million in 2019. And they were scheduled to match the federal exemption as of 2020, but that was before the federal exemption doubled. So we'll see if they rescind that or if they hold true to that statement. And we would love any further questions, or if anybody wanted to get a little more specific on anything or further clarification.